Good day. Ira Epstein of Linn & Associates with your metals market wrap-up for this Thursday, the 18th of June, 2020, getting on to 5:30 in the afternoon. So as we take a look, you can see the gold and the silver down. The copper market still staying very good, still in the near 260 area. Dollar was stronger today at the expense of the euro currency, which got hit. We didn't close one way or the other very strong in stock indices, and we're up tonight in all of them. Metal markets, the energy markets are pretty flat right here. Bonds and notes had a rally. They're giving that back right now. So where does that put us? Well, the markets are concerned right now about the return of COVID-19. If you're reading the news like I am, you're seeing the surge in Florida, Texas, California. There's a number of states where it's going up, and it's getting up to bigger numbers. Numbers that the question is it because of more testing or are there more outbreaks? We don't know. But we're trying to figure it out. The press is playing it down. I don't think you play it down. The other thing that we don't know, we've had all this euphoria in the stock market about a V-shaped recovery. The market has gone back up to levels as though COVID never happened. Is it a bubble? Don't know about that either. We're about to find out. In the gold on a weekly chart, you're down $4.50. You're sitting here approximately $32 underneath the most recent high close, and this is a close-only chart. When we take a look at the daily bar chart, something becomes evident. If you take your pencil, you can draw a line. You can probably do another one if you went from, let's say, this area right on down. So you're forming a wedge in the market at this point. Wedges are difficult to trade because you get attempts to break out of both sides and they give you a hard time. You don't see the wedge when you put the swing lines on. The swing line turned bullish today. You have a pattern of higher lows and higher highs unless 17.1730 is taken out in the August gold. At that point, you'd have a higher high, lower low, and the idea of a trend, if you believe in trends, defining a pattern of higher lows, higher highs, or lower highs, lower lows, being a trend, uptrend, downtrend. No trend has a higher high and a lower low. In other words, they're whipping around. We don't have that. We're in an uptrend right now. The support comes in right here at the 18-day average of closes at 1727.30, which tells me that the pros, just looking at if they think a trend's in place, they might be considering being long at 1727.30 with stops right under the 1720 area. That would be the number, one tick under the last break low. What else is happening is the market is just drifting here. And you can almost see this drift. You try to break away from the 18-day average and you keep coming back at it. We have not had a recent test of the upper Bollinger Band. It's the lower that was tested here. Prior to that, in May, we tested the other number. And what's the importance of that? Markets trade within the black dashed lines 95% of the time. So we have a market that's basically just, if you will, day in, day out, not really going anywhere. When we look at momentum, it was trying to get overbought, and it's not right now. It sort of went flat here. Readings under 70 are not overbought readings. Readings over 70 are, by my definition. So I see an uptrend, upside bias, support 1727.30. The risk on the trend is not to get under 1730. If you do, that breaks it, but it does not start a downtrend. In the August gold versus July silver, market still has a bias in favor of the gold being stronger in silver. When you look at this chart, remember on the numbers, each of these numbers represents in a perfect world how many ounces of silver it would take to get 1 ounce of gold. No commission, a perfect world, just gives you an idea as to where that's at. And when the number's over an 18-day average of closes, the bias is up. When it's under it, the bias is down. So gold stronger, gold weaker is the way to think about it. In the silver market, we're caught in sideways action. The market right now, because of an outside day down today, remember, we're already into tonight's trade. This is how we looked on Thursday, the close of business. Okay, we have an outside day down. Unless this number is taken out, The pattern is now lower highs, lower lows, bearish. The market is under the 18-day average of close. Therefore, my bias is to the downside. I define bias by if the market is trading over the 18-day or under it, either way. And that filters the swing line. If the market breaks down, I'd be looking for support to come in at 1713 because 95% of the time the market will trade in the algorithm called a Bollinger Band. If the market breaks through there, then maybe the 1647 level, the 100-day average, comes into play. What if the market breaks through the highs of today, Thursday? Well, then I consider that a bear trap, and I think it sets up using this as a base to propel the market right up to the potential of the upper Bollinger Band. Don't know if it would happen, but that's what I'd call a bear trap. In the copper market, the market has got a pattern of a lower low here, and I'll use that low and say that we've got the lower high, then a lower low. So you have a pattern that is not trending, and that's what I'm seeing. I also see other divergence. Momentum is pointing down. The bias is up and no trend. So I see a market just dispersing price sideways. In the platinum market, the trend has been to the downside with the lower highs and already the lower lows. You came down today, and here's your challenge. If you look at the low, 805.60, the lower Bollinger Band is 805.20. So you got within 40 cents. You're in the ballpark. You had hit it here. You bounced back to resistance at the 100-day average. You've broken down again in it. We'll see if it hits it again, but I think the pros in that area are looking to take some money off the table if they're short, but that doesn't mean they're walking away from being short unless they're looking at the oversold condition, which I am looking at. And I think when you get oversold, a certain element, be it the algos or traders with experience that use what we'll call a checklist for trades, oversold conditions might, I'm not saying it will, might keep them away from wanting to add on to short positions. The palladium is similar, except the palladium, and I've warned you on this, is forming what I call a pipe. Now, what a pipe is you have a broad range, and then the market starts narrowing it in. It's losing volatility. Along the way, it gets so thin that you get a lot of breakouts, upside, downside, that don't follow through. That's where I think you're at. The trend is down, bias is down, you're not oversold. I wouldn't be surprised if you keep challenging the Bollinger Band, which you did today. You got as high as the 18-day average of closes. You let the pros out at that number, but it's a dangerous trade because you're in such a narrow band, and when you come out of it, you just go zip, you break away. The exchange lowered the margin today in the palladium too. Now, when you start lowering margins, one of the things that happens is often that attracts speculators back to the market. I don't know if that's the case here because I think you're stuck now at what, a $45,000 margin. That's pretty big. In the dollar index, I said yesterday I thought we were close enough to say, okay, I feel better because the embedded reading being lost, you should make a run at the 18-day average. That's my theory. Came up with it in the slow stochastics, and I believe it works often. I cannot tell you it works all the time. I don't know anything that works all the time. But go back and do your own study and you come to your own conclusion. I know what I believe, and I believe it's often. And I'm looking for that 18-day average. It didn't have to hit it. It did it to make me the professor, if you will, feel real good for you. So I see a market that is now in the dollar, has upside bias. Now, it's spent a lot of energy coming up from there here. If we take a look at the most recent low in this market, it did get down to 95.57, and coming back to the 18-day average, while it did issue a buy signal because you've now got the bias up, the swing line up, and momentum up, got to be a bit cautious here. You'd have about in risk almost $1,000. That's a lot of risk, and you've spent a lot of time getting up here. You might decide that, or the market might decide to stall. You know, one of the things that you asked for and I put together was the combo. Now, let me tell you what the combo is. It's the combination of futures and ETF subscriber video. I put out the ETF video at 4 in the afternoon. Roughly, I start recording it. It's out certainly before 5 o'clock unless I have a computer issue. And then at 5:40 in the morning, I start recording a futures video. Why the two? As you know, most ETFs, and I'm not talking the spiders, the ETFs, they'll follow, be it the energy markets, if they're the DIA, SPY, whatever they are, they're going to look at the S&P and the other markets. Futures, do they actually look that way? I don't think so. I think it's the spiders and the ETFs that are geared to those specific markets, they follow them. Well, here's the problem. You do an analysis in the afternoon in the SPY or the QQQ, whatever it is. Where do you go with that? Well, maybe in the morning you want to see what the futures have done and what the analysis there is to confirm, deny a trade idea you might have. So I've put together the introductory price of both every 30 days. It starts at $16.90, goes to $28 every 30 days. You get an awful lot. Each of the videos is about 20 minutes long. I go specific, buy here, sell there, do this. Here's what you do on the other. If it's overnight in the let's assume an ETF, I'll say, I want you to look at this because we might have a report tomorrow in oil. We might have a Fed report. So I always prep you with it. I'm Ira Epstein. Hope you want to take a look at it. You can click up here to get to that page, or you can go to our website under the word research. Either go to the morning subscriber video or the ETF video. You'll see the word combo as you read through it. Take care now.